Hello, good morning everyone. Welcome to Phillip Securities Research Morning Call for 17th of April 2023. For stock counter updates today, we have First REIT, SembCorp Industries and Emperador, and we have quite a few technical analysis and macro and sector updates. So without further ado, I would like to pass on to Jonathan to get started with FAANGM month.
Thanks, Ambrish. So I'll be running through the FAANGM monthly for March this year. In terms of the FAANGM's performance overall, the FAANGM was up 13.6%, while the Nasdaq was up 9.5% and the S&P 500 was only up 3.5%. Meta was the main performer, up 21% due to several reasons. The first is some follow-through positive sentiment on improving efficiency as it started cutting jobs. And secondly, with the potential ban of TikTok underway, TikTok is Meta's main competitor in the short-form video space. So we do think that these two events kind of help to propel stock price for the month of March. Netflix was the main laggard, but was still up about 7% for the month. In terms of what we're seeing for the second quarter, we expect the second quarter demand for PC and electronic hardware in the second quarter to remain relatively weak. At the same time, we are also seeing digital advertising headwinds still persisting. So the recovery really hasn't been quite underway as of yet for digital advertising. Moving on to our next slide, it's basically a snapshot of tech layoffs in the first quarter of this year. You can see in the chart, there was about 155,000 layoffs in tech companies for the first quarter of 2022. Just to compare this to 2022, it's basically almost the same amount as the whole of 2022 combined. Main reasons for this, we think, is because operating margins for FAANGM have been declining quite drastically from about 25% in the fourth quarter of 2021 to about 20% in the fourth quarter of last year. So we do hope to see kind of a rebound in margins, especially as tech companies continue to lay off some of their staff. Although we do expect the layoffs for this coming quarter and moving forward to not be as severe as the first quarter. I think just for some context, when you look at a company like Meta, they basically, so far they've laid off slightly more than half of their total workforce that they added on throughout the pandemic period. So just based on this, there is still room for them to cut, but at the same time, as they continue to grow as a company, you wouldn't expect them to cut all the jobs that they added over the last couple of years. Moving on to the individual counters. So for Meta platforms, like I mentioned earlier, they're cutting another 10,000 jobs, which is roughly 13% of their overall headcount. At the same time, they're also closing another 5,000 vacant positions that they have listed on various job platforms. So it kind of shows that they are actually continuing to reduce their cost structure quite significantly, which is roughly in line with what they've been saying throughout the last couple of earnings calls about how 2023 would be the year of efficiency for them. So we do think that this should be a positive for their margins, which have actually declined quite significantly. Operating margin for 2022 was about 25%. When you compare this to 2021, margins were about 40%. So there was a significant decline in margins for the company. We maintain neutral on Meta platforms with a target price of $200 US. The stock last closed at $221.49. Moving into Netflix. Not much news from Netflix except for some stats on streaming. Streaming continues to take market share from other traditional forms of entertainment like broadcast TV and cable TV. So streaming as a percentage of total US TV market share was at 34.3%, and this was up 1.5% month on month. So there is a clear trend of streaming continuing to pull away from its peers, I guess. But there is also still significant room for them to run because their main competitors are actually traditional TV and cable TV. In terms of streaming, Netflix is currently in second at 7.3%, trailing only YouTube at 7.9%. But just a caveat here is that Netflix is actually the only, or I guess it's the leader of your pure play video on demand streaming platform, whereas YouTube, it it doesn't really fall 100% into this category. So we maintain and accumulate on Netflix with a target price of $388. The stock last closed at $338.63. Moving on to Alphabet, they actually released their own AI chatbot called Bard, which is similar to OpenAI's ChatGPT. And this is actually released for public use. So what the company plans to do here is actually to leverage public users to improve its large language model. Basically, the more data that passes through, the better the efficiency of the product. It kind of feeds on more and more data to become a little bit more accurate in its responses and more efficient. So currently, this service is only available to limited users in the US and UK, but I believe there are plans to roll it out to more countries across the world. Something interesting to note for this is that we do think that there is a potential integration that could be on the cards for Alphabet. They may try to use this chatbot and integrate it into its current search platform, thereby making it a little bit more intuitive and a little bit more efficient. Although, it's still quite a ways away for them to because they do need to collect quite a significant amount of data and to make sure that this chatbot is actually running as it's intended to run. We maintain a buy on Alphabet with a target price of $131 US. The stock last closed at $108.87. So moving on to the next counters of Apple and Amazon. Max isn't here this week, so I'll just present on his behalf. In terms of news for Apple, their main supplier, producer, Foxconn, actually plans to boost its production in India. So it's actually planning to increase its existing plant in Chennai, increasing production by about 20 million units by 2024. So that's next year. Right now, the current output is only about 6 million, so it's quite a significant and sizable expansion. At the same time, they are also planning to build a new plant in Bengaluru. I believe it is also coming this year or next year. So if you combine both plants, the rough estimates in terms of production would be about 40 to 50 million iPhones annually, which represents about 20 to 25% of its total production. So this is quite significant for Apple because it shows that their suppliers are actually willing to make their own investments to maintaining Apple's supply chain and improving Apple's business, and making it a little bit more resilient and less reliant on production in just China. Because you saw what happened over the last couple of years with a lot of these supply chain issues when China shut down. So I guess the company is just kind of looking at different ways to reduce the concentration risk for supply chain. We maintain a buy on Apple with a target price of $186. The stock last closed at $165.21. So moving on to Amazon. Amazon actually laid off another 9,000 more employees on top of their previously announced 18,000 layoffs in November of last year. So these layoffs will primarily affect functions in Amazon Web Services, which is their cloud service, HR, human resources, advertising, and Twitch, which is their streaming platform, live streaming platform. They also are pausing construction on their second headquarters temporarily. So this second headquarters is actually going to be in Arlington, Texas. Although they did mention that the pause is actually not really connected to the layoffs, and it doesn't necessarily mean that more job cuts are on the way. In terms of how we forecast job cuts for Amazon, we do think that based on the current layouts, average revenue per employee should improve by about 11% year on year for 2023, assuming that Amazon doesn't lay off any more employees. So you can see that there is quite a significant improvement in terms of efficiency per employee, as not just Amazon but a lot of the other tech companies start to trim a lot of the fat that they have put on over the last couple of years. We maintain an accumulate rating on Amazon with a target price of $117. The stock last closed at $102.51. So that's all for me. I'll hand it back to Ambrish for Microsoft and to conclude the FAANGM. Thank you.
Thank you, Jonathan. So moving on to Microsoft, there was no such significant news. Apart from that, the company announced a quarterly dividend payout of about 68 cents per share. So the dividend, it would be payable to shareholders on June 8th and to the shareholders as of record May 18th. So to note that the ex-dividend date would be May 17th. So to reiterate our thesis on Microsoft, the main growth driver for Microsoft would be its cloud business Azure, as the companies that digitize their operations. So the cloud Azure, it's a high margin business, and even though it's is slowing down right now, the demand for Azure is slowing down right now. It's still the top driver for it's still the driver for its top line revenue growth. So for the third quarter of 2023, Microsoft expects Azure revenue to grow by about 30%, down from 49% same over the same quarter previous year. And this is mainly because the customers, they have reduced their IT spending due to the economic uncertainty. And meanwhile, Microsoft, it will be impacted by foreign exchange headwinds as well as a weak demand for PC sales. So Microsoft, it has mentioned that it expects its Windows OEM revenue to fall by about mid to high 30% range in the third quarter due to the weak PC sales. And Windows OEM revenue, it's basically the revenue that Microsoft generates from the PC manufacturers like Dell and HP, who install Windows software on their machines. So overall, for Microsoft, we have a buy recommendation with a target price of $298. So moving to conclude FAANGM, we maintain neutral rating. This is mainly because for the second quarter of 2023, we still expect near-term revenue headwinds, mainly the demand for PCs and a few electronic hardwares, it expects to be weak. And also digital ad recovery to be slowing down. It should persist in the second quarter. However, we have increased our earnings expectations marginally due to cost-cutting initiatives by the major tech companies, mainly through layoffs. However, we don't see any significant growth catalysts at the moment for FAANGM. So that's all for FAANGM. I would now like to pass on to Glenn for Singapore Banking Monthly.
Thanks, Ambrish. So for the Banking Monthly, we'll first go to the interest rates. Yep, so for the interest rates, it continued to rise, at least the SORA. The 3-month SORA was up 14 basis points month-on-month to 3.35%. And while the 3-month SIBOR was actually down 2 basis points, so it's rather flat to 4.19%. So the SORA has actually reached its record high at 3.35%. The month-on-month increase was rather similar to the 16 basis points increase in February. However, this is still the smallest growth recorded since May 2022. And the SIBOR month-on-month decline was the second decline since September 2020. The 3-month SORA improved by The March 3-month SORA improved by 310 basis points year-on-year and was 15 basis points higher than the first quarter average, while the 3-month SIBOR improved by 352 basis points year-on-year and was 2 basis points lower than the first quarter average. So with the continued increase in the SORA, and at least the SORA, we can see that the banks will definitely benefit from this, at least in terms of their net interest margins and their net interest incomes. So now moving on to the loans growth. Yeah, however, on the loans growth side, it's continuing to decline in February, and the overall loans fell by 3.1% year-on-year to 804 billion. And this continues to be below our estimate of a mid-single-digit growth for 2023 as the rise in interest rates start to be more fully felt by consumers. The business loans fell by 4.47% year-on-year, and the loans to the building and construction segment, which is the single largest business segment, it grew by 0.28%. But the loans to the manufacturing segment fell by 15% year-on-year. The consumer loans were also down slightly though by 0.86%, as the dips in other segments were offset slightly by strong loan demand in the housing segment, which grew 2.57% year-on-year. For the total deposits and balances, it continues to grow, and it grew 6.06% year-on-year, and However, the current account and savings account, or CASA proportion, it dipped slightly to 19.2%, as there was a continued move towards fixed deposits due to the high interest rate environment. For the Hong Kong loans, the domestic loans growth declined by 3.28% year-on-year and fell by 0.6% month-on-month in February. Now moving on to the next slide. For the SGX statistics, the securities daily average, or SDAV, it fell by 22% year-on-year in March to 1,216 million, as the market sentiments remained subdued at the start of 2023 due to the macroeconomic factors. However, the VIX, which actually is an indicator of volatility, averaged 21.6 in March, and this is up from 20.1 in the previous month. And this is mainly due to what's happening in the US with the collapse of the several US banks. And the DDAV, or Derivatives Daily Average, fell 11% year-on-year to 1.04 million in March. However, for the first quarter, the SDAV was down 21%. As I mentioned earlier, the market sentiment remains subdued, while the first quarter 23 DDAV was relatively stable and only down 4% year-on-year. For the top 5 equity index futures turnover, it saw a dip of 19% in March, and this was mainly due to lower trading volumes of its FTSE China A50 index futures and the FTSE Taiwan index futures. However, notably, all 5 index futures grew month-on-month, with the Nikkei 225 index futures showing the biggest growth of 83.6% month-on-month. So for SGX, we actually still maintain a buy, and this is mainly due to its the continued growth in its DDAV. So for March, we can see that there was a dip, but this is the first dip for about a year. So, we do expect the DDAV to recover and to continue improving. And secondly, the derivatives pricing is also continuing to increase. And this should see that we should expect the derivatives pricing to continue to increase, and this would be beneficial for SGX. And the last point, and I would say the rather important one, would be the continued increase in their treasury income due to the higher interest rates. So with the higher interest rates, they were able to earn a larger sort of spread on their collateral balances, which they hold around 14 billion of. So with the higher interest rates, we should expect this to boost their treasury income by at least 100% increase for SGX. And as such, so we maintain a buy on SGX. So now moving on to the next slide. So to conclude for the banking monthly, we do maintain overweight and we remain positive on the banks. The bank dividend yields are attractive with upside surprises due to excess capital, as well as a push towards higher ROEs. And the stable economic conditions and the rising interest rates remain tailwinds for the banking sector. And as I mentioned earlier, SGX is also another beneficiary of the higher interest rates due to the uptick in their treasury income. Okay, now moving on to the next slide, I'll just do a quick update and summary on the 3 US banks that have released their first quarter 23 results. So across the board, I think, so the 3 banks are JP Morgan, Citigroup, and Wells Fargo. So I think across the board, what's happened is that their net interest income has shown a huge jump, ranging from 23 to 49%. And this is mainly due to the continued high interest rate environment, which has slowed down to their net interest margins and concurrently their net interest income as well. So this has shown a huge boost for them. However, the non-interest income has continued to slow, but it has slowed. It has dipped at a slower pace this quarter. So we can see that even JP Morgan has shown an improvement of 5% in their non-interest income. Citigroup has a dip of 3%, which is rather flat, and Wells Fargo at negative 13%. I think the main concern for their non-interest income would be the investment banking, which all 3 banks have shown almost a double-digit decline. But we should sort of expect this to reverse, as this is already much lower than the previous few quarters. I think the other big talking point would be the provisions change. So provisions change here, I think let me explain a bit. So this provision change, I'm comparing year on year. So this compared to first quarter 23. So this figures means that the provisions have increased. So they have increased by 0.8 billion for JP Morgan, 1.2 billion for Citigroup, and 2 billion for Wells Fargo. And I think the main reason for this is because there was a lot of reversions during the 2021 period when the US banks were starting to reverse their GPs. So they started to slow down at the start of 2022. Hence, we can see that the provisions change have at least sort of gone back to a more normalized level, and we should expect this to continue to flatten. And overall, to conclude, the increases in their net interest income has more than boosted their PATMI growth, and you can see that they have sort of reported rather good results, with JP Morgan being the best at a 52% growth in their PATMI. So I think that's all I have for the banking sector. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. So we visited some of First REIT's properties last month. So this site visit note on it with the title Greener Pastures after the lease restructuring in back in 2021 January. So First REIT, just some brief company background. Its market cap is 526 million. It's a healthcare REIT with assets in Indonesia, Japan, and Singapore. So they just acquired their Japan portfolio of nursing homes in 2022. The AUM is 1.5 billion. It has a portfolio of 32 properties, but the AUM value, most of it is in Indonesia at 72.1%, and the next is in Japan at 25%. The sponsors are OUE and OUE Lipo Healthcare. So for the lease structure, you can see on the right, for Indonesia, it is the higher of the annual base rent escalation of 4.5%, or the performance-based rent, which is 8% of the hospital's previous year's GOR, the gross operating revenue. So far, 3 or 4 of these hospitals in their portfolio have already been contributing the performance rent for FY22. So going forward, we hope that more can contribute this performance-based rent. And for Japan, is annual rental, it can be revised upwards every 2 to 3 years based on negotiations and the CPI. And for Singapore, it's just a fixed base rent of annual increment of 2%. So the key thing to note is that 85% of their rental comes from Indonesia. So the important thing we need to take note of is more of the Indonesia's rental structure than the other Japan and Singapore. So the bottom left graph you can see is their lease structure before and after the restructuring of the master lease agreements with Lipo. So before that, Lipo Karawaci contributes 88% of their rental, and right after the restructuring, Lipo Karawaci and Siloam contribute about half each, and then going forward after 2026, we can project that will contribute 81.3%, because this is inside the MLA, the master lease agreement, that after 2026, if let's say all of their hospitals in Indonesia starts contributing the 8%, then 6.5% of this 8% performance-based rent will be paid by Siloam, and the other 1.5% will be paid by Lipo Karawaci. So this is a good sign, because right now Lipo Karawaci has been making losses. It's in the red since 2019, while Siloam has been very profitable since 2020, especially since that they have been seeing a steady rise in non-COVID patient volume. So Siloam is a strong balance sheet, while Lipo Karawaci is kind of in a red. So we like the fact that right now Siloam is contributing more as compared to Lipo Karawaci. So their risk profile has definitely improved. Next slide, please. So some of the site visit highlights. Their First REIT's property is underpinned by tertiary care hospitals. So tertiary care hospitals is more like your specialist that needs an inpatient care. Primary care is more like your GPs, and secondary care is like outpatient specialists. So First REIT is the portfolio is underpinned by these tertiary care hospitals because these cases are more complex as well. So the revenue intensity and the margins per patient is higher than secondary and primary care. And what we noticed at all their site visits, like we visited 5 of their properties, is that there's AIs to improve customer experience and facilities, and all these are at the expense of the operators themselves. So this in turn will help to improve the customer experience and perhaps possibly the rental income that the hospitals can collect as well. So some of the comments for First REIT is that the good thing is that a bigger contribution from Siloam, as I mentioned in the previous slide, that going forward. So the contribution will rise from about 50% in the latest financial year 22 to over 80% in the longer term. And First REIT also has a 2.0 growth strategy, which is to expand its portfolio into developed markets to more than 50% of the AUM. So right now, the developed market AUM is about more than a quarter after the Japan acquisition. And we also think that there's more room for acquisitions in Japan, especially since that cap rates are still stable and the interest rates there are low. But another possible acquisition is in Australia. So all these are possibilities. They also have a right of first refusal pipeline from OUE Lipo Healthcare as well as Lipo Karachi, but those are not the priorities as of now. So another thing is that right now, since the SGD is strong, the Sing dollar, it is more costly for medical tourism to Singapore. So like a lot of their Indonesia, their locals, previously before COVID especially, they used to travel to Singapore to seek treatment. But right now, since it's more expensive for them to seek treatment in Singapore, they are looking back at their own Indonesia hospitals for treatment. And other possible potential customers can be from the Southeast Asia region as well, as they look to other countries instead of Singapore for treatment. And one thing is that since the majority of their portfolio, the rental is collected in Indonesia rupiah, they suffer from this currency risk and currency volatility, but this is slightly mitigated by the 4.5% increase in base rent every year. So as a result, we do not have any stock ratings or price target for First REIT as we do not cover them. But right now they're trading at a 0.85 price to NAV with a 10.1% dividend yield. Next slide, please. Yeah, so the next slide are some descriptions of the properties that we visited. Like Siloam Hospital's Lipo Village is a JCI accredited hospital. So in Indonesia, it is a big thing for a hospital to be JCI accredited, unlike in Singapore, where in Singapore all the hospitals are already JCI accredited. So out of the 5 assets we visited, Siloam Hospital's Lipo Village as well as Kebun Juruk, which is in the next slide, also is JCI accredited. So these are just some quick descriptions. MRCCC is a very specialized cancer hospital where they have the state-of-the-art technology. As you can see, one of it is the PET-CT equipment in the picture on the right. And on the top right is also the newly renovated pharmacy and reception area. Yeah. Next slide, please. Yeah, so this Siloam Hospital Kebun Juruk is the other JCI accredited hospital. And Siloam Hospital's TB Simatupang, they're famous for their wellness center, and they have a rooftop garden at the outside the wellness center. Yeah, next slide, please. And the last asset we visited was the Hotel and Country Club, AHCC, and this is a non-core asset and is being marketed for sale. So when we visited this asset, we saw that even though there were many facilities, but it's quite a rundown and there weren't many people there. So we can understand why First REIT is trying to divest this. And yeah, so these are some pictures like the gym area. This is the renovated room. Yeah, but the thing is that right now, they just resigned a lease and is for 1 year and is renewable 1 year. So instead of just so while waiting for the sale, they're just collecting some base rental for this asset. Yeah, next slide, please. And yeah, so they have a Max Coffee at all of their hospitals that we visited. So this is a famous coffee chain. And on the right is the helipad at MRCCC. Yeah, so that's all for me. I'll hand over the time to Peggy to talk about SembCorp Industries. Thank you.
Thank you, Darren. Good morning, everyone. This is an update on SembCorp Industries. we are introducing our FY24 earnings forecast estimates. Just a brief highlight, we are raising our target price to $5.06 from $3.68 earlier by a previous analyst. We changed the methodology to a PE valuation because the renewable energy assets are beginning to contribute, and it's going to be contributing in a big way from FY24 onwards. Okay, let's go back to the conventional energy. Singapore continues to be the biggest asset allocation. 70% of their assets are in Singapore, and Singapore power capacity has been almost fully contracted till 2024 after the latest contract signed with Micron for up to 450 million megawatts. So, and in Singapore, they earn a fixed spread over the cost of energy. So the volume is more important than the price. Can I go back to the earlier topics? Thanks very much. Okay. Then on top of that, in Singapore, the EMA has announced a plan to call for proposals to raise the electricity generation capacity by 2028. They project that peak and electricity demand will rise to up to 11.7 gigawatts by 2028. And our current capacity right now in Singapore is only 11.8 gigawatts. So we are almost nearly full by then. Therefore, we need to increase this. But because of the higher interest costs and the uncertainty over the type of fuel and the transition to clean energy, investments in this space has been quite subdued over the last few years. Therefore, it's the first time in the decade that the AMA has stepped in to call for proposals directly. Okay, but Singapore conventional energy, under conventional energy, the contribution will drop because last year, because of the sudden spike in prices up when the war between Russia and Ukraine erupted, there were some opportunities in terms of hedging gains on by SCI, and also and also they had some spot capacity which they could sell at the higher spot prices. So going forward for 23 and 24, we're projecting lower contribution from this segment, and also because that they had sold their India power plants for 2 billion early this year. But the sale will not dent profit as much. The contribution is under discontinued operations, which was 144 million last year. But in turn, they actually provided vendor financing to the buyer, and that financing will earn them interest income, which we estimate will generate about 132 million per year. So that more is almost offset the gain from the India power plant. Yeah. But in terms of growth, renewable energy will be very important to them. They have ramp up their capacity in this area very quickly. Last year, from end of last year to currently, they added 24% at capacity. And because most of these capacities are in China and India, they will benefit from the reopening in China and a very strong demand in India with the establishment of more manufacturing bases by MNCs in India. But in terms of providing cash flow, land sales will be important. This is grouped under integrated urban solutions. They have most of the land in Vietnam. They intend to ramp it up again to sell 500 hectares in 2025. Currently, it's only hovering about 170 hectares per year. So they're going to use this to provide the cash flow for them to further invest in renewable energy. But with that, still, because of this stronger cash flow, we expect net gearing to fall to below 1 time by end 2024. So we maintain a buy recommendation with a target price 506. Just some charts to show the things that they have been doing. Like last year, USEP is the Uniform Singapore Energy Prices. It's actually been falling. It's now down year on year compared to the same time last year. But but for some of us, our energy bill will still be rising in April and May because our fixed term has expired. Okay. But then but still, as a whole, the Singapore prices are coming down. But the prices won't affect them as much as the volume is more important, and they earn a spread over the volume, over the cost. Okay. In terms of the renewables assets, the gross installed capacity has jumped from 2.6 gigawatt in FY20 to currently 10.3 gigawatt. That's a 3-year CAGR of 58.2%. That's all from me. I hand it over to Zane. Thanks very much.
Thanks, Peggy. Good morning, everyone. So now I'll move on to the technicals. Next slide, please. So for the S&P 500, last week, we are still trading within this uptrend channel over here in the chart. So for the current, the week ahead, the resistance will likely be at 4,160, which was the highs of last week. And the next resistance up will be around 4,200, then followed by 4,300. As for the immediate support, it's likely to be at 4,050 to about 4,100. So for now, the trend is still bullish, unless we break down of this current uptrend channel. Yeah. Next slide. So we have a report on should you sell in May and go away? Okay, so I think most of y'all would have heard of this saying, which means that an investor can improve their own returns by selling in May and then and reinvesting back in November. So this saying actually came from an English saying back in the old days when people actually left London to the countryside. So they would sell their stocks as they would not be able to monitor it. When applied to the stock market, it refers to the market performance where the summer months have historically averaged lower returns compared to the others. So some of the possible reasons could be that investors actually believe that in the summer months, there's general lack of market participants, which could lead to a low volume, low return environment. And then in the US, it could be due to seasonality in investment flows as a result of the mid-April income tax filing deadline. When we look at the Singapore market, most companies actually pay out dividends in May and June. Thus, those investors who are actually looking for dividends, they may not actually buy in until significant dips are actually created in the market. Looking at some of the stats, for the past about 30 years, the S&P have returned about 2% from May to October, while the other months in November to April has averaged higher returns of about 7%. Then when we look at Dow Jones in the past top 10 years from November to April was about 27.5% compared to an average about 2.9% only in the May to October periods. So maybe that could be the reason for this effect. Next slide. So when we look at this chart, which actually details the performance of S&P in May, and then whether it belongs to the top 3 worst performing months of the year, and then S&P annual return as well as the worst month of the year for the past 30 years. Actually, we can see quite a lot of green compared to red in this chart. So to break it down, S&P actually gained in about 21 of 30 years in the month of May, which is about 70% with average return of 0.56%. Contrary to popular belief, it's seldom been among the top 3 worst performing months. Yeah, only about 5 of the last 30 years. And then when we face with a negative May, S&P have generally still performed well over the year, generating positive returns of about 9% in 7 of those 9 years when it was red in the past 30 years. Also, May it's not the worst performing month. It's usually joined with September, October as well. So that's why it explains the weaker performance during the summer months because of these 3 worst performing months usually. Next slide. So in conclusion, while it's true that the seasonal market performance in the months of May to October have lower returns compared to November, April, it's not true that May is usually a bad month. It's usually a good month, and investors should remain invested through the month of May, as the predictive power of this saying is actually quite questionable, and its effect has actually tapered off over the last decade. Over the last decade, only once has May posted negative returns. Yeah. And then if enough people were to believe of this saying, they will actually try to front run the other investors also try to sell in April, and then this saying will actually not be true as well. Yeah, so this is just a short summary of this saying. Next slide. Okay, so for individual stocks, there's a few of them. So first one will be Mapletree Industrial Trust. For this is a technical buy at $2.38 with take profit levels at 246 and 255. Stop loss can be placed at 233. It last closed at 239 on Friday. For Mapletree Industrial, we saw a breakout of this consolidation triangle in the chart. And then the good thing is that it also retested the previous resistance at about 237, which was now turned into a horizontal support level. So with that, if the price continues its bullish momentum, it could first retest about 246, which was a previous support broken down back in September of last year. And then subsequently 255, which is a swing high level back in September last year as well. And it will be confluent the downtrend resistance line too. Next slide. Our next one will be Uber. So for Uber, there's a technical buy at $31.74. Take profit can be set at $33 and $37.40. Stop loss can be placed at 30, and the stop last close at $31.48 on Friday. For Uber, there's a potential breakout of this downtrend channel. So recently, it did a double bottom formation at $30, and then subsequently started to trade a little bit of sideways ish. While the MACD is starting to have a little bit of a positive crossover, which signals that bullish momentum might be coming. So with that, with a potential breakout, to first retest 33, which was a horizontal support level that was broken down in just last month, and then subsequently could reach about the 3740 level, which is a significant resistance formed in February this year, as well as in April of about last year. Yeah. Next slide. The next one is Del Monte. For this, we have a technical buy at 24 cents. The take profit can be set at 27.5 cents and 29 cents. Stop loss can be placed at 23 cents. The stop loss goes at 23.5 cents on Friday. So for Del Monte, in the current downtrend, we could see a potential rebound to retest these two resistance levels. Reason being that the price has started to actually trade sideways following a sell down earlier. And during this process, we saw there's bullish divergence on the RSI, which signals that some strength is coming into the stock. And with that, the price could first retest the 27.5 cents level, which was a previous support that was being broken in November of last year. And then subsequently 29 cents, which is a 50% Fibonacci retracement level when we take the highs at 35 cents and the lows at 23 cents. For Del Monte, for our fundamental recommendation is a buy with a target price of 40 cents. Next slide. Next one, it will be Ping An Insurance. So for this, it's a technical buy at $51.55. The take profit levels can be set at $56 and $59. Stop loss can be placed at $48.50, and it last closed at $52.10 on Friday. For Ping An Insurance, it has a bullish breakout of this descending wedge over here. And what happened was that it had a retest with a bullish hammer candlestick. So it's a bullish sign together with the bullish momentum seen on the MACD and RSI indicators. So with that, should we break above the $53 short-term resistance, we could see price going up to $56 first. Then followed by $59 eventually, which is the projected target level when we take the height of the wedge and project on the breakout point. This level also meets with the 61.8% retracement level as well. Next slide. So the last one will be Broadcom. So for this, we have a technical sell at $621.57. Take profit can be set at 546. Stop loss at 644, and the stop last close at $619.54 on Friday. For Broadcom, there's a potential breakdown of this bearish rising wedge pattern. This was formed after the stock tested a double top in May this year. And currently, we can see a weak momentum in both the MACD and RSI. There's actually bearish divergence, while the stock was actually climbing higher or sideways. So with that, should price come down, it could eventually reach 546, which is a key horizontal level that was experienced a strong resistance back in August of last year, and then a support in January this year as well. Yeah, so I think that's all from me. I'll pass on my time to Paul to talk about Singapore Weekly.
Yeah, thanks, Zane. Next slide. Okay, so we'll just run through the usual macro data from Singapore and also the US. So for Singapore, there wasn't really much macro news, but there was a lot of land transport information, i.e. ComfortDelGro and SBS Transit. So for rail, SBS just released a monthly data. So for March, rail ridership is up 36%. But for the quarter, it's up about 38%. So ridership is still robust. And ridership is important for rail because that's where they collect revenue directly for rail. That means they take on ridership risk. Whereas if you are on the bus contracting, this is more fee income and there's no ridership risk. So ridership risk, what I mean is that the revenue they collect actually comes from the passengers like ourselves. But for bus, no. Bus is just a fee that the government pays. For taxi, there was some data. The data comes from LTA. It's a bit sporadic. There's no schedule, so you virtually have to kind of refresh the website. But year to date, taxi distance travel is up about 6%. So what we do see, I think no surprise to everyone, street hail is still down 15%, but ride hail, which means ride hail from apps and so forth, is up about 10%. One positive was that the ComfortDelGro's taxi fleet is down about 1%. So this is the slowest in more than 6 years. Because that's as far as the data we got. But I think if you look at it, it's probably the slowest since the arrival of all these all these ride-hailing companies. The other thing is US CPI came up. This is an important number. But the problem, so CPI was down 6% to 5%, mainly because of energy and oil price is down. But the core CPI, that was still stubbornly flat. That was flat compared to last month. But what we do see is some positive signs. I think services, excluding shelter, because services is the part where the inflation is still very stubborn. It doesn't seem to come off, but beginning to see it start to slow the level of growth. The other data on inflation that kind of had boosted the market was PPI. So just to refresh, I mean, CPI is a consumer price index. That means inflation for consumers, but PPI is, you can say, like inflation for manufacturers. Basically, the cost of goods for manufacturers. So that was down from 5 to 2.8%, quite a severe drop. And usually when that happens, it means that inflation for goods, that means manufactured goods, should also be coming down. There was also retail sales in the US, maybe not much headlines on that, but actually it came off quite sharply. The growth in US retail sales was down from 7% February to 3.6%. So US consumer is starting to spend, US consumer spending is starting to slow quite drastically. It's the weakest growth since the pandemic. Another negative sign indicator for global growth, that means what's happening in the whole global exports, especially electronics, was Taiwan and Korean exports. We should be also monitor, just to get a sense of what's happening globally, not to just look at Singapore exports, but it's also continued to come down. I think this is like the 5th or 7th month of decline. So Taiwan exports is down 19, Korean down 14. Year to date is down 13 to 19. So in part of the whole weak electronic sector or big demand from electronics. So technically what we see is that, no change in our view. The interest rate peak theme is still intact. I think what we see globally is slower growth and moderating inflation. So what we mean is that interest rates have either peaked or might possibly be a cut. I mean, depending how deep the US recession is. So in this type of environment, we overweight duration assets. That means we overweight assets that have no long duration, like REITs, and then and so we think also the other tactical part is, like as what Glenn mentioned, Singapore Bank should have some positive spillover from the strong US bank results, especially the net interest income. Then for ComfortDelGro, at least the data is trending well. What we can see, we can't see every single point because they also have UK and Australia, but at least for Singapore, the data is all pointing well. There'll be a slew of Chinese data coming up on 18 April. You get fixed asset investment retail. We think that will disappoint because Chinese data, they normally don't release January because it's Chinese New Year. So they normally only release their February data by this week. So, but we think it'll be disappointing mainly because I think it's quite widely known there was a huge pandemic wave and infections in January. So don't expect strong data. But again, this is important for us because a lot of our Singapore companies is relying on a rebound in China in the second half. You're talking like companies like Wilmar, even CapitaCorp, Land Sales, CapitaLand, some of the banks too because of the Hong Kong. So the Chinese data will become important, but we just don't think you should expect any strong data coming up on the 18th, which is tomorrow. Then we will have 2 webinars this week. We will have MindChamps and also Sabana REIT if anyone is interested. MindChamps is tomorrow. Next slide. So just to show you why we think global growth is decelerating. So on the left is the exports out of Korea and Taiwan. So the exports are down for some 5 months, some 7 months a year, continuously year on year. It's actually back to the worst performance since the pandemic recession. US retail sales also surprisingly also down very sharply. You can see the chart on the right. So it's back to pre-pandemic levels, maybe about 3% of growth. But again, the issue for US is also the huge inventory that they have. And if their inventory is at record level while retail sales is coming down, you can only assume that the inventory levels in the US will continue to build up. So that's why we think if there is a recession, it will be mainly coming because of manufacturing, just too overstocked, just too much inventory. Next slide. But for Singapore, we think Singapore economy is in a really good shape. So the table on the left is just the foreign direct investments as of December 2022. So you can see that in Singapore, our foreign direct investments is 141 billion. It's a record level. Slightly higher. Last year you can see the chart. Last year was only about 140. So it's modestly higher, but it's still a record level. And the red line is basically the ASEAN 5. So the amount of investments that come to Singapore is double what they have in all the 5 ASEAN countries combined. So some of the other things that we think will keep the Singapore economy vibrant is tourism is up 11 times. You're going to count a year on year for this quarter. Property price is up 11%. Of course, this can be good and bad to it. There's always this risk of cooling measure. Then our retail sales in Singapore is up 6%, 6 times faster. Construction, the economy will get fiscal support because construction will be supported by extra 90 billion of the Singa bonds. So I think basically they will spend I think maybe 3 billion a year on Singa. That means infrastructure spending that will be funded by these bonds that is not in our government budget. But this could boost construction spending by maybe 10% a year. So you get this extra stimulus for infrastructure spending in the country. Of course, job vacancies is robust, and one way to play the domestic, at least the most liquid shares, like banks, retail, return it will be like malls and hospitality. And next slide. So this is the operating metrics for I think you can see the real is rebounding quite sharply. So March is 1.1 million average daily ridership compared to 800,000 a year ago. So you get this year-on-year boost. The taxi fleet, you can see it totally collapsed. I mean, the last few years, but it's starting to stabilize a bit right now. The bar on the right, on the chart on the right. Next slide. Okay, this is just the CPI inflation. I know the chart on the left is a lot of lines, but I guess the one that is stubborn is the blue line. So inflation is the red line, but the blue line is where services is very stubborn. Yeah, it's surprisingly goods went up, but the services we think is starting to peak a bit. You can see the blue line starting to peak everything, and the yellow line is also dropping. Sorry, it's very confusing, but anyway, these are because CPI got many components, so we just want to show you that. Most of the indicators are starting to roll over. The lines, starting to roll over. The one on the right that helped push the market, at least in the US, was the PPI, which is the red line. So this is goods inflation, which is inflation faced by manufacturers, and that totally collapsed. In part, a lot of it due to energy. Next slide. Okay. We have one more slide just on Emperador. We don't cover, but just that we attended the analyst briefing. Just to for anyone who did not manage to attend the briefing. So just to reminder, Emperador is a Philippines company. They are a brandy and whiskey owner and producer. So they entered whiskey after they acquired the Scottish whiskey company, White and Mackay. And so for brandy, which is the original business, mainly 90% of it is sold in Philippines. And then whiskey, their most famous brand is the Del Mar. It's a luxury brand. Then they are trying to push Fatter Cane and Jura. So the earnings was up about 6% fourth quarter. You can see the table on the right, but most of it is driven by whiskey. So whiskey is the strongest business, and the brandy is weak because of the slow Philippines economy, and also because brandy is affected by increased the margin collapse. So you can see a brandy revenue in the fourth quarter up 11%, but the EBITDA or operating profit is down like 20%. So for brandy, what they're trying to do is just to raise, because Emperador is a bit of a lower price product. They want to premiumize and promote the more expensive ones. Then for whiskey, whiskey is doing well because it's on global allocation, which means a lot of distributors want to buy, but they can't get enough supply. So what they said was that they are only meeting 50% of global demand because maybe distributors want 100. I mean, it's obvious because distributors maybe want 100 bottles or whatever, then they can only supply 50. So with that benefit, they can continue to raise price. So because the volume is fixed, because these are brandy maybe 12 years, 18 years ago, but they raised price. And this year, I think they're looking to raise whiskey price by 25% at the minimum, I think. Yeah. And also the good thing about having whiskey that was distilled or packaged 10 years ago is that you're using 10 years cost. So when you distill all this whiskey, talking about another cost that there was much cheaper, lower energy costs, lower raw materials compared to right now. So of course they are also a beneficiary of rising inflation because they don't face this higher cost because it's all been bottled up or distilled. Sorry, yeah. The expansion, they're going to open a new whiskey distillery, completed in 2024, but don't expect any production because they need a minimum of 12 years. So this is a very long dated business. So so for this new factory, only in 2036 will you see any production, which of course most of us will not be covering this time. In terms of the outlook, I think growth will be driven by price increase. And because what they say is basically there's no sensitivity to demand. I mean, it's like the best business around. You just increase price 25%. Some of the bottles, I think they might have increased it, doubled the price, but the demand is still there. It's not affected because there's a shortage of such luxury whiskey. Their strength is mainly in North America and China. Yeah. Okay. I think that should be all for me. I think next slide. Yeah. I think we can move on to question and answers. Thanks.
Yeah. Yeah, so I'll begin the Q&A. There's a question. Good morning, Team Sasa has been inching back since its high in February this year. China is reopening, but why is Sasa pulling back? Yeah, so I don't see any specific news to Sasa since it's quite a while. So I don't really know exactly why the Sasa is pulling back. I can't say for sure, but it is definitely in line with the rest of the China, the Nasdaq Golden Dragon China Index. So when you just take up the chart, it's actually since March, the China Dragon Golden Index also put back similarly to Sasa REIT. So maybe from a technical standpoint, Zane can answer that, but from a fundamental standpoint, I don't see any particular reason because I don't see any company specific news as well for that. There's one question. Just out of curiosity, why do you do site visits and presentations on companies which you don't cover or which you don't stipulate target prices? Yeah, so the biggest reason is because of exposure for these listed companies. Because we only cover a handful, like a small portion of all the stocks in the Singapore market, but we're trying to get more exposure to all the lesser known counters as well. So that's why we do these presentations and on these companies we don't cover. It's also why we try to do as many company guest presentations as well. Even though we don't cover a lot of these companies, but we still host them for company presentations, guest presentations. And there's Sabana and MindChamps coming up this week. So I'll leave this question here as well in case any of my teammates got other things to add. And what is the latest on Manulife US REIT? Thanks. Yeah, so the latest for Manulife last week was that they managed to divest one property. It's called Tanas Bond at $33 million to the sponsor. So actually, it's a book value. So they managed to divest it at book value, and and they chose this asset mainly because it didn't cross the 5% threshold of the net tangible assets. So this 5% is if you cross it, that means you need to have an EGM. But then if it's lower, then you don't need to have an EGM, and you can just divest it. It is an interested interested person transaction ITP threshold of 5%. Yeah, so this is the MAS rule. So yeah, they divested this asset, and they'll be using it for operations and like liquidity for now. They haven't really said what like they haven't really said if they'll pay down the debt using these funds as well. So it's mainly for liquidity. And the other update is also the strategic review. So the strategic review, I think there was a leak, maybe maybe last month, I can't remember exact date. There was a leak that Mirai will acquire Manulife or something, the manager. But that is it's still in discussions. Okay, so at first there was news that Mirai will acquire, but then the value was off. So I think it was 200 million. That was the number is not true. It's not factual. So Manulife came out to say that, oh, this is still in the cards. This so-called acquisition is still in the cards, but the figure is off. Yeah, so a lot of the market is also thinking that, or rather assuming that this Mirai acquisition will acquire the whole stake from Manulife. Then Manulife will like want to wash their hands off, like Manulife, the current sponsor, want to wash their hands off Manulife US REIT, but that's actually not the case, because as you can see that in the news update is that Manulife will actually they'll increase their stake, and like if let's say more shares are issued to Mirai Asset Management, then Manulife will consider taking up more stake or more shares to maintain their stake at about 9.1%. So right now, the latest is that Mirai and its affiliates are looking to subscribe to 9.8% in Manulife. Yeah, so all this is still in discussion, and there's no final terms or no concrete details yet. So we can only wait for more information, probably in the next earnings call or the next update. Then we can get more information on this. So as of now, not much, no final details yet as of this Mirai, but it's still in the cards, basically. Yeah, I think that's all for me. I'll hand back to my team for now.
Hi, this is Peggy. I'll take over the question. There's one question on which has better prospect, Keppel or SembCorp. Okay, if you look at the two, SembCorp has earnings visibility. There's certainty of earnings. So if you like earnings, this is the preferred. Keppel, on the other hand, has is a divestment story. It's going to be a lot of asset monetization. They mentioned today in today's papers on the selling of their legacy assets. There's also talk of them disposing M1, but we don't think that'll be so soon. And of course, we also think that they might want to reduce the stake in Keppel REIT. Currently, the stake in Keppel REIT is about 47 to 49%. So as Keppel will be a divestment story. In terms of earnings, it's still playing catch up. In the renewable space, the SembCorp's renewable is about 3 times larger than theirs. And Keppel's main earnings contribution comes from the sale of residential units, and most of their land bank, actually about nearly 40%, is in China. So like Paul mentioned earlier, China reopening and rebound in the property market holds a lot of significance for Keppel Corp. So if both will be buy, but one is on earnings, Keppel is on a asset valuation angle. Thank you. I take another question on Keppel infrastructure. I'll try that one, though we don't cover it closely. Okay, Keppel's infrastructure will be announcing a preferential offering exercise today for retail investors. Illustrated price provided earlier was 0.518. The price has reached a low of 51.5 cents today. Kindly provide your opinions on this preferential offering exercise. Thank you. Okay, in reply to Mr. Lai on this slide. Okay, if you look at KIT's, the gearing is latest gearing as at end of first quarter is 42.5%. They benchmark themselves to the MAS guideline of 45%, which also leads us to think that their interest coverage ratio is below 2.5 times right now. The average cost of funds is 3.7%, but the term maturing is about 2.7 years. They have a short-term bridging loan of 438 million as at end of March to finance 2 acquisitions. They took up this bridging loan, so this preferential offering and the placement that they did earlier were mainly to repay this bridging loan of 438 million. So can't say whether it's good or bad. The rationale for doing this very clear. They want to reduce their gearing, improve their balance sheet, and also to repay these loans. This is there has to be bridging this is very, very short term. So they really have to settle this very quickly. So the Keppel infrastructure is well, or rather, if you look at Keppel infrastructure raising funds, maybe Keppel Corp would look more interesting because some of these assets are coming out from Keppel Corp to be injected into Keppel infrastructure, and that means Keppel will be able to monetize and realize more cash from this exercise. Yeah, thanks. I'm sorry, I hope I answered the question, but not very well. And thanks very much. I pass it back to the team. Thanks.
Yeah. Okay. Can I go to that slide? Someone. Okay. Anyway, just to update on the Cecil REIT. The only thing probably not this page. I think you would. Someone's asking the first. Yeah. This page. Okay, the only thing holding back, I guess, is for Cecil REIT is that we don't think the first quarter earnings will be strong, because I think with all the lockdowns and the whole first quarter basically will still be quite weak, we think. No, because retail spend in whole of China, everything was in lockdown mode because of the pandemic. Not only did because although there was relaxation, but a lot of consumers did self-imposed isolation because there was a pandemic spreading. So we don't think first quarter will be good. But the whole year should be better, which is pretty obvious, because last 2022, the worst of the pandemic was in May, and also they had to give a lot of rental rebates. So we think Cecil would directionally would definitely recover, because you're comparing to like all Singapore companies comparing to a pandemic year in 2021. Just that in the first quarter, we think it will still be a bit sluggish. In terms of why we do site visits presentations, again, it's just to give a broader coverage for everyone, a broader update for all the companies, because for site visits, it's a bit more unique, is because the analysts might spend 1 or 2 days in a site, and in theory, they should actually know much better. I mean, they should have a very good insight to these assets, and we also show you pictures and so forth. So it's mainly to give everyone a broader update of all the other stocks, because there are like 600 over stocks. We cover maybe 40, 50. So and we also get a lot of questions about other companies. So that's why we also do all this. The only things we don't share is sometimes we have one-on-one meetings. Then of course that is a bit we won't share. We can't share that. But for the broader ones like Emperador, when there's a group meeting, then we can share with everyone, so that not everyone can get to this access to these meetings either because of time or they limited to just analysts. For KIT, I think like what Sikela mentioned. I mean, if the preferential offer is 518, the share price is 515, then no purpose to go and take the preferential offering. I think my own thoughts about KIT is that they are buying regulated assets. Regulated assets in general, there isn't much upside when you buy regulated assets because it's all covered. So your only advantage is your cost of funds, and with interest rates so high, I'm not sure they have any more advantage. And also do note that some of our capital infrastructure's assets are maturing a few years later. So we always worry when you have an asset that's maturing so soon, are you really getting return on your capital, or just return of your capital? What we mean is, I mean, in the past we used to discuss with them, you lend me $100, I pay you back $10 for 10 years. Is that a return or is that return? So, but anyway, so that's the second thing we worry, and also rather than a buyer, because like SembCorp and so forth, they are developer of infrastructure assets. So we prefer those who can develop something from greenfield. We're not sure when you're a purchaser of these assets, how much value add can you give? Especially you're buying assets in Saudi Arabia, you're buying assets in Philippines, and then you have some in Australia, some in Singapore. Again, these are our own thoughts. I know how much value add can you, or are you're just it may be. So unless you have very superior cost of funds, then I think it's probably an interesting stock. Otherwise, regulated return assets are very poor. Okay, that's a very long answer. Any thoughts on ComfortDelGro? Yeah, I think we've already shared. I think we think the operational data looks positive. Sorry, Paul, your general view of local construction sectors, namely sectors, counters in this sector, example BRC and Ping United. So, for us, we think the building material companies will have very good visibility because so many infrastructure projects, but it won't be very high growth. So don't expect like 20% growth. We are looking more like mid-teens kind of growth for them at best. But it's just that you're going to get a mid-teens growth or high single-digit growth for the next 3 to 5 years. That's very good visibility at the city, but ultimately, you're still buying into the whole Singapore market. So it's just you're buying stability. You're not buying for high growth, and you buy into these building material companies. And of course, not construction stocks, because construction is very competitive in Singapore. I mean, most of the big jobs are all done by foreigners, the Chinese companies, Korean companies. I'm not sure why they want to come here, but it's very hard for any of our local construction companies. And in fact, most of the building material company customers are actually this huge Chinese, European, and also Korean contractors here. So actually, the local contractors don't really do many of the big jobs. That's why we prefer the building materials. Is Genting Singapore overvalued? Has it got more upside? Okay, actually there's a Genting Singapore AGM which I will attend. Then if there's any interesting comments, we'll do a film on the ground. The only thing we can say is that Genting Singapore pre-pandemic price was about 92 cents, and then now it's 117. So, and gaming, casino is it's a really mature business. So I think there's still maybe another two more, maybe another 12 months of results momentum because no reopening effect. But like we mentioned before, although we don't cover Las Vegas Sands, if you want something that is more broad-based, you can get the pent-up demand in Macau gaming, then that would be Las Vegas Sands, and they are still trading below the pre-pandemic. So although we don't cover, what we do is we just look at the pre-pandemic share price. So for Genting, it was 92 cents, and then for Las Vegas Sands, I think it's probably like 20% still below pre-pandemic. Yeah. This is just a shortcut answer. We don't have like bottoms up. Any views on Yang Zhejiang finance? I'll leave it to Peggy for that. Okay, I think some of them, the rest can, a lot of them REITs. I think Darren, you can take.
Any view on fears of US commercial property crash and any implications on Singapore, especially our commercial property market and our REITs? Yeah, so the US commercial property, the crash, a lot of it is the assets are located in downtown LA and a lot of the gateway cities. So it's not that the whole US commercial property is very bad. So the worst hit is mainly assets in LA and some in California, where a lot of the companies are shifting out towards like Texas, etc., to a lot of the red states. So it's not I would say it's not the whole US commercial property is bad. Yeah. So based on that, we really have to see where the assets are located, as some assets are still showing some strong demand, especially in Texas. Yeah. So any implications on Singapore? Yeah. So from that standpoint, I don't really see much implications other than the negative news flow, where every other day you see negative news, and which is also why all the US REITs are being sold down so much. Because every day you open a newspaper, you see some other manager of US commercial property defaulting on their loans. So yeah, because of that, the sentiment is really very bad. So right now, I think that's the only thing that will probably affect the REITs share price, which is the US listed ones. But for the commercial property market in Singapore, it is still quite resilient. Like just last quarter, the rental was all-time high at 1170 per square foot. And we think this will maintain around the levels of, because of the kind of tight supply. The next biggest supply is coming up in the end of the year, the IOI Central Boulevard. But other than that, yeah, the supply is still relatively tight. So I don't really see much impact on the commercial property space in Singapore, especially now that most companies are adopting at least a three-day work week. So most workers, especially in the CBD area, are already back to office. So the demand is still there for Singapore. Yeah, the other question is, given what I shared on Manulife just now, should one wait out for a positive outcome or better to exit? Yeah, so this is I can't really comment as well, because this is just speculating whether they have a positive outcome or not. So yeah, I can't really comment on that. Please provide your views on Paragon REIT and how its performance will compare with SCT and Maple Asia. Yeah, so for Paragon REIT, its biggest asset is of course Paragon, and which is a central area mall. While FCT, their malls are more in the suburban areas, and in the past year, the rental reversions for suburban malls were way better, like high single digit, while the rental reversions for these CBD area, central area malls, like downtown malls like Paragon, is still negative. But we expect these rental reversions to kind of increase, and perhaps if China tourists returning, this could help benefit the downtown area malls and their rental reversions going forward. So yeah, that is the comparison with Paragon and SCT. But Maple Asia is, in comparison with these two REITs, is way more diversified. Yes, it has other assets as well, either asset classes like industrial, office, logistics, residential. Yeah, so it's not really a apple and apple comparison between the three REITs, as their assets differ. Like Special Paragon is in the downtown and FCT is suburban. Yeah, but we cover FCT, we don't cover Paragon and Maple Asia. Yeah, and I guess for FCT, the update was just that they managed to secure a new tenant for their Century Square. Their Century Square asset used to be FilmGuard, but Cathay is taking over. I think that was announced last week. Any views on MLT? Yeah, so for MLT, we don't cover, but the logistics space is still doing quite strong in Singapore. Actually, especially like since this e-commerce boom from back then. Yeah, so specifically MRT, I can't really comment, but in general, the logistics space is still very strong. Yeah, and I can't really comment on that for now. I need to do more homework on that to give a better answer. Yeah, I think that's all for me for now. Misha, if you like, could you drop me an email? I will do some research and email you more on that. Yeah, thanks.
Yeah, I'll take over the question.
Okay.
Sorry.
Just let me do one question first, Peggy. I got one question. I think it's regarding the bank. So it's asking if USA were to have a slow landing, mild recession, will the SG market be adversely affected, especially banks, considering Singapore is a safe haven? Yeah. So I would say if it was mild, I mean Singapore and the whole world, not just Singapore, I guess, will definitely be affected, adversely affected. So I think the two things that will happen mainly would be maybe a larger slowdown in loans growth, and the second one would be might be an uptick in NPLs, which is not non-performing loans. So those might be the two things that will happen. But I would expect that the Singapore banks, I mean, on the bank side, it might not be as badly affected as compared to in the US, because as you said, Singapore is a sort of a safe haven. So it will be less affected, yeah, if it's a mild recession. Yeah, hope that answered the questions. Hand it over to you, Peggy. Thanks.
Thanks, Gwen. Okay, I'll take the question on your views on Yangzijiang Shipping and Yangzijiang Finance. Thanks. Okay, we think growth for Yangzijiang Shipping could be quite limited. If you just go, let's look at the order books. In 2021, they gained 7 billion of new orders. 22 only 4 billion. So the order books, even though right now it's at a peak of 10.5 million, is the growth has slowed down. And the companies have said that they really want to go back to focus on chemical tankers, because the LNG carriers construction takes too long and take up too much of their yacht space. So the yachts is full as well. So we see very difficult to see growth when your yachts is full, unless you increase your capacity. And on top of that, their order books, a lot of that is 50% actually came from the Chinese shipbuilders, ship operators, and still a lot of that is from container vessels and bulk carriers. So we'll worry about the decline in freight rates and how these orders will be impacted, whether the operators will change their mind about taking delivery of the ship, since the delivery time is further down the road, 24 to 26. So for Yangzijiang Shipping, we think is a bit on the high side, fully valued. The only thing is they had a good order book, good cash in their balance sheet. So there's one beauty of this company. So there's no gearing issue for them. Unlike what we saw in the last round of shipping, when the shipyards were impacted, most of them were dragged down by a high gearing. Okay. For Yangzijiang Finance, they have an AUM of about 4.1 billion, which is a good size, but most of the earnings they want to focus on fund management. And as most of you are aware, fund management, you really need to build a track record. So in the initial years, we probably won't see any much of the asset sale or divestment gains that will bring in the performance fees for them. So again, it's a long-term play for Yangzijiang Financial, and they spent 100 million in the buyback last year. You see the share price hasn't moved very much, so there's some indication there for us to consider. I hope I answered the question. Thank you very much. Okay, sorry, there's another question on ST Engineering. I will try because I'm not very, we don't cover them very closely, but based on what limited knowledge I have on the Cross Island line. Okay, sorry. The question is, any comments on ST Engineering's getting the contract for Cross Island line? Would it contribute to its share price going forward? We think it's the impact is not going to be very significant for them, as most of these contract will probably be parcel out to subcontractors, while ST Engineering might just be the main coordinating the work. So we don't think it's going to be a big on their bottom line contribution. Thank you. Pass it back to my colleague.
Yeah. Okay, let me take a few before I have to leave. But so anyway, the Cross Island line contract is 200 million. ST Engineering's order book now is 23 billion. So this is like less than 1%. So we won't have any impact for ST Engineering. Of course, it's nice to have 200 million is still a big number, but compared to their order book is quite small. And just to give you some flavor, like what Peggy mentioned, Yangzheng shipping, most of their order book comes from container. Container rates are down 80% this year. So I mean, the bigger worry now is whether any of the customers want to defer receipt of the ships that they are building. So I guess the bigger risk now is, will any of the customers, I wouldn't say default because they make a lot of money, but whether will they push back or renegotiate on the price. And so that's probably a bigger worry now for Zhangjiang shipping, because the rates are just totally collapsed. The next one is Sheng Siong and Propnex overvalued. Is there catalyst for good growth? Okay, so for us, we still have buy on both. For Propnex, mainly because of the rebound in the property sector. So there's good earnings visibility, and I think they're because the share price moved recently, they're still paying like a 6% dividend yield. The dividend yield is supported by 50 million of payout, which they generate from their annual cash flow, and they have another 140 million cash standby. So they can maintain this 50 million, roughly 50 million dividend payout. Oh, sorry, my video. They can retain this 50 million dividend quite comfortably. So that's the reason why we still have a buy. For Sheng Siong, we have a buy too, just that the growth won't be so great yet because they're still feeling the effect of households eating out more. As you know, Sheng Siong benefited because of the lockdown. A lot of people household dining was all done at home, but right now most of the dining has also shifted to restaurants, so they will have still some lingering effect. The supermarket data, if I can recall, was supermarket sales. I think this year, at least January, February, was down maybe I think 4 or 5%. I don't have the exact number, but it's down. So this year the earnings would be probably like a low single digit. But it's exceptionally resilient because they are still taking market share in supermarket or grocery sales as they take market share from the wet markets. But the big one for them, the big growth driver for them is, of course, new stores. I think they have like 60 stores, and I think, although they not explicitly mentioned, I think they can accommodate even doubling of the stores. So they're still going to grow, considering how many stores NTUC has. So they could easily double and still cannot match up with NTUC. But for them, it's mainly HDB stores. So with more BTOs coming out, that will also help. So they're looking at maybe 4 to 5 stores a year. And this will give them some growth, 4 to 5. So maybe like some 7-8% of growth for them. But the big one will be China. So they have 4 stores in China. There are eventually plans to do it up to 30 stores because it's China, right? But anyway, they're just going to focus on one province. If they do a massive growth, then that is a hidden growth catalyst for them. But this is not something in the next 12 or 18 months, but it's something that they are continuing to build a foundation. So they've been in China, I think, more than 5 years, and every year they need to open 1 store because they have been monitoring. But only the last 1-2 years they've been more aggressive in opening stores in China because they have become more more comfortable. But it's something to watch. It's not, not going to happen now. But if they really ramp up, I think 30 stores is like a minimum for them if they want to go all out and ramp it up. So this is like 50% of their existing storefront. Okay. Let me answer this. Okay. What is the implication of MES keeping SGD policy unchanged? I think not much impact. I think maybe maybe go shopping Johor might be affected, but really no impact for investors here. In general, if the MES keeps this increasing the slope, is usually only a 1-2% impact on the currency against our neighbors, against RMB, against. But in terms of the impact to the stock market, is really hardly anything. Yeah. So let me answer this last one that I have to go. Any view on China Aviation? It might do well with China. Yeah. So we like we don't cover, but we like China Aviation because there is visibility. So most of their business is doing all trading. Maybe 1/3. The other 2/3 comes from like we highlighted before. They have a petrol station for aeroplanes in Shanghai. I mean, of course, it's more sophisticated than that, but there's only one. So they do earn cost plus margin for them. So they earn money because they sell. China Aviation will sell to the Pudong Airport petrol station, and just use it. Of course, they earn some maybe like 20-30% per barrel spread. Then that company itself will also make money by earning a spread over the petrol price when they sell to all the aeroplanes when the airplanes leaving. So they used to make like almost 80 million in general for all the associates. This year is only 15 million, 2022. So with the reopening, the earnings can double, triple for that part. So there's going to be strong earnings. Just directionally will be strong, but the timing, the steep, whether it will be very steep growth, it depends on how fast they reopen in China. Yeah, I'm not sure if Peggy or anything to add. Yeah. Okay, I need to. Okay, thanks. John, do you have any AI ETFs? I'm not sure if you got any AI ETFs that you can comment. Yeah. Thank you, everyone.
Yeah. Hi. Yeah. So there's a question here. Whether there are any AI ETFs? Sorry, let me try and find it. Yeah. So I guess from on the Nasdaq or the New York Stock Exchange, there are a few. There's one called BOTS, BOTS. That's the ticker symbol. And then one of its top holdings is actually Nvidia. But most of the AI, there's no like real pure play AI ETF. So most of these ETFs are actually they combine robotics and AI together. And actually there are several out there, but they're all very different in terms of their composition of companies. But in terms of size, which one has the biggest fund size? It will be BOTS, BOTS, BOTZ. Sorry, yeah. Other than that, I don't think there's really much else. I hope that answers your question. Thank you. I think we can probably move on to TA with Zane right now.
Okay, let me just share my screen right now. Okay, so I'll start off with APAC Realty. Recently looks like we actually broke out of this key resistance line over here, this downtrend resistance line. Price has been moving up, but for now, it could be encountering some short-term resistance based on this previous swing high around the 69 cents level, which was created in August of last year. So that price could sideways for a while. For now, current support could be supported at this recent swing high level around the 66.5 cents level over here. If price continues to move up, break this resistance, I think the next level we could be looking at is closer to the 71.5 to about 72 cents horizontal level over here. Next one will be Thai Bev. Okay, for Thai Bev recently, it looks like there's a breakout of this downtrend channel over here. Price has found support around this swing low level around the 63 to 63.5 cents level. Resistance is about 66 cents onwards. There was a retest of its highs around the 68 cents level. So I think price probably move continue sideways in a range for now for dieback. And this one is Agricultural Bank of China. For this price, I think we have broken above key resistance level on the $2.90 mark. Currently, it's trading in an uptrend channel over here. Short term wise, I think the next resistance level will come in around the 3.1 to about 3.1 level onwards, which is there was a previous horizontal resistance over there. Yeah. Then if price remains above 3, it will be bullish as well. The psychological level as well as the previous horizontal support level over here that we cleared recently. Okay, next one is a few other Hong Kong counters. 3032 Hang Seng Investment Management Tech ETF. For this one, I think currently price is still since last week price has pulled back a little bit. We're still finding resistance at this neckline of about the 4.2 onwards over here. Currently support probably coming between about 3.9 to about 4 over here, this previous resistance that we broke out of, as well as this downtrend channel and the swing lows over here as well. So I think for now, price will probably be kept in this box, this range for now. Next one is Tencent. Tencent recently looks like we had a breakdown of price broke down over here. So for now, looks like some support is coming in from this previous horizontal level around 352 that we broke out of. So there was a retest back on Thursday. We saw some buying over there. Currently, support will be over here. Resistance upwards, I would think, is probably from 375 to about 381 over here. Reason being previous resistance over here, then we found a support over here, this range, but it was broken down with the high increase in volume. So probably short-term resistance will come in over here. The next one is JD. JD recently also quite weak. I've seen quite a bit of a pullback. Currently price is supported around 143, which is a swing low over here. So we did a retest on Thursday. Today we did a retest as well. Price needs to get above it, bounce off meaningfully to continue to make sure that it doesn't break down further. Yeah, so currently resistance probably be from about 150 onwards to about 156 over here. Price needs to be supported at 143. If not, the next level you could see is probably 137, which was a previous swing low back in October over here. Yeah. Then we could do a retest of this downtrend channel breakout as well. Yeah, over here if price actually breaks below 143. Next one is 2318 Ping An Insurance. So Ping An, I think is the stronger Hong Kong, one of the stronger Hong Kong stocks for now. There's a breakout of this bullish descending wedge and a retest based on this hammer candle on Thursday. Price is still in this big range consolidation taking place for over a month for now. So we need to see this $53 break over here. Then we could see the first level of resistance at 56. If not, if price is still trading in range, we could find support on the $50 level over here, which is a support. So let's see whether price is managed to break out following this break from this bullish pattern. Next one will be Capital Land Integrated Commercial. I think for now still remaining bullish. We are still above this line break 197. Price is trading in the range currently. We have this trend line support over here as well. So as long price is supported along this trend line as well as above this 197 is still remaining bullish. Short-term resistance upwards could be from about $2.03, which is this. You can see previously there was this key neckline resistance over here. So over here, currently price is finding some resistance over here as well. If you do break above the next level, could be around 206 to 207, which was a previous horizontal resistance over here as well. And as well as a horizontal level over here that broke down off that spark, the selling over here. There could be a retest of this uptrend channel previously that was being broken down as well. So there's a confluence of resistance over here around 206, 207 things. Next one, Samudra Shipping. Recently, there was a break of this downtrend resistance line. Price has, I think there was a gap up after it announced the dividend date. But price has just been sideways for now. So can take resistance wise, I think we can take it from 140 onwards to 146 for now. Support wise, I think currently is still supported at 134 over here, which was a previous resistance highs for this range over here. Probably some sideways trading for now, I think somewhere. And next one will be Delphi. I think Delphi for now price is currently just range over here. You can see resistance is from about 111 to about 115 for now. Then support is coming in probably at 105, 106. Yeah. But then something to take note is that while price was making a higher high previously, both MACD and RSI were making lower highs. So there's bearish divergence observed. So there could be some weakening of the strength for Delphi. If price is unable to make a higher high afterwards. Then for now, it could be supported by the test of this breakout of uptrend trend over here. So 105 to about 106, 107, there could be some support temporarily for now. Next one is SMIC. For SMIC, the trend currently there could be some short-term resistance at this close to the 20. Currently is about $25. There was a 61.8% Fibonacci retracement level. The highs at $30.80 and the lows at $14.72. Then previously in September, November 2021, you can see there was two swing highs created at this level that could be a resistance, short-term resistance over here for now. Then current support-wise will probably be this 20 level that was being broken out over here. And this one is China Merchants Bank. Okay, for this, currently I think price is currently just trading in a range for now between $39 and $41 over here. But we could possibly see some breakout if price moves higher. There was some bullish momentum both on MACD and RSI, so there's a chance that for now there could be a breakout. With that, then the next resistance level to look at is probably at $43, which was a previous horizontal resistance over here. Yeah, $43 about $45 will probably be the next target range if a breakout occurs. Okay, then next one is city developments. City developments currently, I think we are still consolidating in this flat pattern over here. It could be bearish as the prevailing trend over here is bearish. So if we do see a breakdown occur, then it could be a continuation of a bearish momentum taking place over here. For now, current resistance probably at close to 750, which is this swing high over here. If price breaks down, I think the next support level we could look at is probably a retest of near the lows around this $7 mark, which will be confirmed with this main trend channel over here. And this one is the OCBC. OCBC currently not much happening. We are just range trading over here. Currently, resistance wise, I think it's closer to 1290. There's a trendline resistance over here, as well as a previous support that was being broken down over here as well in January, February period. Then support wise, we are seeing it around the 1265 to about 1270 over here for now. And there's also a trend line support over here. So price is just trading sideways. We see what's the next movement for it. Okay, then for Genting Sing, currently price is just ranging. So this was after it hit the resistance at 118, which was a previous swing high back in May 2018. So the next level, if it breaks out again, will be about 123, which is another high back January 2018. Then for now, support wise, I think we are seeing some support around 115 to 116. Then if this doesn't hold the next support level, probably 112 to 113 based on this gap over here for again. Okay, then 3033, CSOC asset management Hang Seng index ETF. For this, we are still finding some resistance at 420 over here to about 435. This resistance zone. Price is still probably just ranging for now. Support will probably come in at 390 to about $4 over here. Yeah. Then 2822 is the China A50 ETF. For this, also quite a range for now. You can see resistance is at close to the $14 level. 14 to about 1420 will be a resistance zone for now. Then support is probably at around 1330 to 1360 over here. So probably nothing much for now. Price is just range trading for now as well. Today for SGX. Okay, SGX, we had a breakout of this downtrend channel over here. So currently then we had a retest that was being supported. Price is currently just sideways for now, I think. So the resistance level for now is around 960. Then looking at the past the next swing high is probably around close to 975 to about 980 over here. That will be next resistance level. Okay, then for ST Engineering, currently, I think see a little bit of a pullback for now. So the next support level to look at probably be near the 350 mark, based on previous swing high. And then there was a short period of consolidation over here, then a breakdown and recovery and consolidation over here again. Yeah, so this for ST Engineering. Next one will be First Resources. Okay, First Resources looks like there was a breakdown of this uptrend line support over here. So currently we could be at the near a support zone. So previous swing low was around 150 and 151. So over here we could expect some support coming in soon. Yeah, so this for First Resources. Then resistance will probably be around 154 to about 158 for now. Okay, then China Aviation. Okay, then for China Aviation, looks good currently. I think there was a break out of this downtrend channel over here. So as long as price is still supported above around 94 cents and above, still remaining bullish. Then short-term resistance wise, probably from about $1 onwards to about $1.03. Yeah. Okay. The next one is TSM. Okay, for TSM, I think I'm a little bit bearish for now. So we actually broke below this uptrend support line over here. And then there was a breakdown of this crucial neckline around $91. So for now, price could find some support based on these swing lows around 85 to 86. Then the next support level could be around 82 to 83 based on this channel support as well as the previous resistance over here. Then for NVIDIA, there could be a potential head and shoulders that's starting to form over here. So we need to clean back above the neckline 270 onwards to remain bullish. If not, we could see some little bit of a pullback towards the channel support based on this channel over here. So next, that could bring us to maybe 250 again, to about 250 to 255 based on these swing lows over here. Next one, BYD. And for BYD, I think currently still bullish as we have broken out above this downtrend channel over here. Then currently we are seeing resistance at around 230 for now. But price is still trending quite nicely. We have an uptrend support line over here. So this could be an ascending triangle in the making. So the outlook is still bullish. Probably just some form of consolidation first before another possible break upwards. Okay, then next one, Baidu. Okay, for Baidu, I think still bullish as well. Descending wedge breakout currently looks like a retest, and it's near this swing low support level as well, which is around 124. So over here, we are near the support zone for now. If price rebounds on from here, will be bullish signal. For now, current short-term resistance probably around 137 onwards to about 142 over here. Okay, then next one is capital and investment. I think for now it's still remaining bullish as well. We are still above this downtrend resistance line breakout. Price is just currently just sideways over here. So we still await the next move from this range about 370 to about 380 over here. Okay, then the three local banks. Okay, I start off with DBS first. DBS, I think currently price quite stuck in a range for now. The resistance is at about $33. The next resistance will probably be at $33.40 over here. Currently looks like we have a support of this uptrend support line as well. Then support wise, we could see around from $32 to about $32.30 for now. So probably just like a range over here. And for OCBC, okay, OCBC I covered earlier. And next one is UOB. UOB also you can see it's quite range over here for now as well. So the resistance over here near around $30.10 to about 20 cents. Still acting on it. You can see support is still coming in quite okay, around $29.90 over here. So price is probably gonna just trade in the range for now still. Then the next level upwards will probably be at $30.50 to pick up. Okay, then next one, Tencent and Alibaba. Alibaba, we have this uptrend support line over here. Then So if it is supported over here, we can price can move back above this $94-$95 level, which is this horizontal support level, will still remain bullish. Then we can look for maybe a retest of this 101 highs again. But if price breaks below this uptrend line, right, then could be a bit bearish for now. Then we could maybe retest this swing high around near 90 over here. Okay, then there's a question on iFast as well. iFast, we have a break of this wedge over here. So price is currently just still remaining above the wedge, so still okay. By short-term resistance wise, we could see maybe from close to 495 to about 510 over here for now. Then support wise, we could see probably from if it does a retest of this, probably we could see if it does a retest of this wedge over here, as well as confirm with this swing lows over here, and that could be a good buy signal as well near 460. Yeah. Okay, I talk about Micron. Okay, Micron, I think the resistance is still pretty stubborn near 64 to $64 over here. And previously 65 was a previous support level here as well. So it's quite a lot of resistance over here, still waiting to be cleared, I think. But overall, currently still bullish as we have a breakout and a retest took place. And currently price is just trading sideways over here. You can see the support is at around $61. So as long as if the price tries to make higher lows over here towards the resistance, then it will still be a bullish signal. Okay, next one will be Cloudflare. Okay, for Cloudflare, price currently above this $62.50 level, still okay. So with that, if price can continue to trade upwards, then we could be looking at probably maybe $68 to about $72 next. Yeah. Then Bank of America. Okay, Bank of America looking good after last Friday, or we actually above this $29 neckline. There was resistance over here. So with that price, if continue the bullish momentum, we could be looking at the next resistance being at $30 to $31 over here. $31 being a previous swing low support, and over here turning to resistance over here. Mesh, and there's a question on Metro as well. Okay, for Metro, I think generally the longer term trend is still in a downtrend channel for now. So currently the support is still around the 60 cents mark. You can see 60 cents to 60.5 cents support is still holding over here. Resistance probably from 62.5 cents to about 65 cents over here. Yeah. Then I'll do a SembCorp and StarHub before we finish off the session. SembCorp recently priced did a double bottom at around 50 cents. Then we are trying to trade. We trying to trade higher with a breakout of this downtrend resistance line, but also we have a resistance coming in from this previous uptrend support line. So price is probably going to face resistance and support over here currently. So probably we could see a range probably between 51.5 cents and then to about 53.5 cents or 54 cents over here for now. And this one will be StarHub. A StarHub, I think we are still trading at near the lows of this range. So probably support is at $1 to $1.02. Then resistance, probably we're gonna see it from about 105 to about 107 for now. Yeah, nothing much has changed. Still probably just range trading for here. Yeah, I'm just trying to squeeze in the last two questions on PropNext and TJ Darentang. For PropNext, still looking bullish. We could be testing this trend line resistance over here around 206, 207. So price is actually above this previous high near the 199 mark. So still remain bullish. But that, there could be some resistance coming over here based on the channel resistance. Then support wise could be near term wise could be around 198, 199, or this horizontal level as well as the previous high over here. And for TJ Rentang, still very bullish. You can see price is just trending upward. I think it's the all-time high, if I'm not wrong. Looking back, yeah, it's the all-time high. So for resistance wise, I can't really determine for you. Price can continue to go higher. Support wise, I think for now it'd be good if the daily lows of every day is continuing to make higher daily lows. So that will be a sign of bullish momentum. Unless we see maybe like a start to see bearish candles coming, then that could be some cautious signal. So I think that's all from me today. I'll pass back my time to my colleagues for any closing remarks.
Thanks, Tim. Okay, so I guess we've come to the end of the webinar. Do feel free to post any questions into P3 community groups if you have any, and we'll try to get one of the analysts to answer it as soon as possible. So that's it. I'd just like to thank everyone for joining in today. Also, if anyone is interested in tuning into the MindChance webinar tomorrow at 1, feel free to sign up as well. Otherwise, we hope to see you again next week. Have a good week ahead. Bye-bye.